This is Colin Cattell with Palisade Radio, and on the line with us today is returning guest Brien Lundin. Brien is the owner of Jefferson Companies, which owns and organizes the New Orleans Investment Conference. Brien, welcome back to the show.
Glad to be here, Colin.
You had some major guests this year, including Alan Greenspan, Charles Krauthammer, Mark Faber, Doug Casey, Peter Schiff, who we just had on the program last week. Let's start with Alan Greenspan. What did he have to say about gold and Fed policy at the New Orleans Investment Conference this year?
Well, he had some really stunning things to say, and it's actually made its way onto CNBC, some of the reports of what he said, and we have it compiled in our gold newsletter issue this November, a more full report of what he said and some transcripts coming out later. But he made some big news. He said things like the Fed really isn't independent. He said that there's the level of quantitative easing that we've experienced is not only unprecedented but incomprehensible, and that there'll have to be some type of a major market reaction once as we withdraw from quantitative easing. He said that the price of gold he wouldn't give a prediction on the price of gold 1 year out, but he said 5 years out it will definitely be measurably higher. I was very pleased that he essentially agreed with my thesis for some time that the reason why we haven't seen retail price inflation due to all this quantitative easing has been because of the excess bank reserves, which now total some $2.7 trillion and are sitting on account at the Fed on behalf of banks. And the banks are getting about 0.25% interest on those reserves risk-free, so there's no real incentive for them to put that money in to work in the economy. But Greenspan says, and I fully agree, that this is sitting there like a tinder waiting for a spark, and once that tinder is lit, there's going to be an inflationary explosion in the economy. And a lot of people don't really appreciate that. They wonder why there's no price inflation. We've had all the quantitative easing, and obviously it's been painless so far. But this is going to happen. These reserves have to get into the economy at some point. Then monetary velocity will increase, and we'll have a dramatic price reaction in terms of retail price inflation. And that, I think, is going to really propel gold and silver higher.
That's a really good point you make. I think most investors put Alan Greenspan in the same category as Bernanke and Yellen, and you're almost suggesting that either he's not in that same category or he's now out of the Fed, so he's able to say what he really believes.
Yeah, a little bit of both. Greenspan is a diehard gold bug, and in his presentations at the conference and in private conversations with me and a few other speakers, he really reiterated that fact. And of course, he's well known for his writings in the 1960s when he was in Ayn Rand's inner circle to some degree. And some of his writings back then about gold were really the most eloquent that were written, and he said that they were some of his best writings in his opinion. So he's an ardent gold bug, but he was thrust into this position where he's in the middle of the planned economy and pulling the levers of the economy, which is just antithetical to everything he had ever believed in before. So that was one of the things that we really pursued in talking with him, and it was very interesting to get his responses.
Let's move over to Doug Casey and gold manipulation. And Doug, over the past few months, has been very vocal in interviews that he doesn't subscribe to the idea of gold manipulation on a massive scale. I understand that there was a debate between GATA and Doug Casey at the conference. How did that go? It must have been very exciting.
Well, it was exciting, very interesting, and frustrating as well, because, Doug's opinion is essentially that, of course, gold is manipulated, all markets are manipulated, but it doesn't really matter, and gold has risen despite that. So if there was any manipulation, it wasn't very effective. On the contrary, Chris Powell presented reams of evidence where the central banks have actually admitted to managing the gold price. And his point is of course, that the gold price would be much higher were it not for these manipulations, and that you have to fight against and rail against these overt and covert manipulations of free markets whenever you can. Some think that it's merely tilting at windmills, but these guys do a good job of bringing a lot of these actions by governments and other forces to light.
I think that most attendees, maybe including yourself, probably had their mind made up beforehand on whether they believed in the manipulation theory or not. But walking away without going in with too much of a preconceived idea, who do you think kind of won the argument?
Well, it's tough to say one side won the argument over the other. I've been a follower of GATA's for many years, and I've seen a good bit of the evidence that they've presented. But I think Chris Powell presented in a very compelling fashion in that debate. So, it made me convinced a bit more that there's a more active manipulation of the metal. I think Doug doesn't necessarily dispute any of this, but disputes perhaps the effectiveness of it or even the extraordinary nature of it. He thinks the central banks will always manipulate markets and intervene in markets, and that it really has little effect over the longer term. So that they both, I think, had valid points, and in truth, they could both be correct to some extent.
Tell us about a speaker we might not be aware of and the topic that they discussed, maybe one of the most interesting speeches or presentations at the conference.
Oh, wow, there were a number of them. We had a new speaker here, Trey Nippa, who was a commodity trader, who basically is shorting the Japanese bond market.
Sure,
and
I'm actually a good friend of Trey's, and I have a position open with him, so go on.
Yeah, so he's a pretty dynamic guy. I mean, he got onto the stage and immediately jumped off it and was running around the audience and really very dynamic and causing our audiovisual people nightmares trying to keep him on camera. But he's a dynamic guy. He makes a very powerful case. He basically agrees with the thesis of Kyle Bass, and I think it's a compelling case that seems inevitable. So he was a great new speaker, and we look forward to having him back.
Following the New Orleans conference, gold has started a very steep drop-off. Today we're recording this interview on Thursday, and there's a little bit of a rebound, but the last couple weeks have been pretty terrible. What was the consensus at the show, which was, of course, things weren't quite as bad at the show. They were looking like the bottom was in. Who was vocally bullish, and were there any bears or perma-bears at the show?
We had a couple of people involved in the physical markets that were thought we might have another leg down. One was Dana Samuelson on our precious metals panel, who thought we would take another leg down. But the bears, frankly, were few and far between. There was a real sense at the show that because the 1180 floor, basis New York spot, had held 3 times, that was a very solid support line, and that the downside risk was minimal, and no one was really willing to predict when a turnaround would come. But the general consensus was, even amongst the most pessimistic attendees and speakers, that the bottom was in to some degree, and of course that proved to be incorrect in the days following the conference. So at this point, from a technical analysis standpoint, it doesn't look very good for gold because there's really not much support underneath it. The encouraging thing, and one of the things that I stressed at the conference, was that Asian demand, particularly from China, is really exploding and is nearly on the same level as last year's record-setting levels of demand. So that's a story that's largely untold in the mainstream financial media right now.
The last couple weeks have just shown how impossible it is to try to time a market. I know we had Eric Sprott, Rick Rule, Don Cox, maybe a few other very big names on the show in the last year, and they were quite convinced that the bottom had been put in, and now it's fallen through. Do you believe, and maybe the consensus among the people that you've spoken to since this fall has started to occur, that there's a lot more downside at this time, or have you decided to just remain silent?
I wish I could remain silent, but people keep asking. From a technical standpoint, it doesn't look good for gold right now, and you would think there'd be a further drop toward the $1,000 level. But fundamentally, we have tremendous physical demand that's draining Western supplies, and has been for all of 2013 and all of this year. And we have a market from a structural standpoint extremely short in the paper gold market. And that's why I think, and perhaps I'm talking my book here, but I think that technical analysis tends to fail with gold to some extent because the price really isn't driven by supply-demand fundamentals, but by a paper market where the amount of gold that's traded is 40, 50, and recently even as much as 120 times the amount of physical gold available. So, that it's a matter of sentiment, and sentiment based typically on wrong reasoning that drives the gold market, and short-term sentiment at that. So I think that the market is so short right now. Any significant bit of bullish news could start a short covering rally, and so the further down we go, the further that spring gets compressed. So that's why I'm not too concerned right now, because I know that when the turnaround comes, it'll be just a bit more explosive.
There seems to be a general consensus in place amongst gold bulls that despite what's happening in the short term, there are so many catalysts in place that are already happening, or a black swan event that could trigger a rush into gold, that we're certain that gold is going to go up, these stocks are going to go up. You just talked about China. What about the Swiss initiative that a lot of people don't know about? How could that affect gold?
Yeah, that's a short-term impetus. That would be extremely bullish for gold. That's going to come up on November 30th, and if there's significant polling of the populace before then, and that's released, then the market will be able to somewhat discount the result. But I don't believe there's much. I've only seen one poll result that showed pretty widespread support for the measure, but nothing much since. And so that's something that could provide one of those rare unexpected surprises to the market, and it would be extremely bullish. Some are expecting, or I've seen some predictions, that it would provide an 18 to 20% lift to the gold market right away. And of course, that could be the thing that sparks some short covering. And in fact, that could spark short covering in the weeks just ahead by the very virtue of the fact that you don't want to be short the metal if that referendum passes.
And that's the type of event that, in my opinion, could really spark some public movement into gold. Just imagine waking up and going to drudgereport.com and it says Switzerland votes to back their currency in gold, which would be a pretty accurate way to describe the measure if it were passed. Yeah,
and from a real-world supply-demand standpoint, it would entail the purchase by the Swiss National Bank of about 300 tons of gold a year over the next 5 years, which in a tight market, in an ever-tightening gold market, would be very significant. But I think the broader significance is that it could spark a popular move in a stated percentage of your reserves in gold. And furthermore, you say there's this much gold in the national reserves. Well, who's auditing that? One of the things that we pioneered or helped pioneer in the 1990s was the work of Frank Veneroso, and we actually published the gold book that he put out in 1998, detailing how the central banks had been loaning their gold reserves out for years to the bullion banks, which then immediately sold the gold, used the proceeds to buy treasuries and other secure investments that they could use as collateral for much riskier investments. And then at the end of that process, or eventually, the gold price started rising, and no one really knows if those IOUs were ever recognized and whether there was actually physical gold to pay that paid off those debts back to the central bank. So where citizens may think they have a certain amount of gold reserves in their central bank, they may actually just be paper IOUs.
Yeah, it's really, really hard to know any of the numbers that are coming out, and if anybody has the gold that they're saying they have. On a slightly different topic, out of all the commodities that have dropped since this bear market began. Oil has held up quite strong until the last couple months, where it's gone down to around $75, $80 a barrel. Talk about how that could actually inversely affect gold and could really help the gold miners moving forward.
Well, from a sentiment standpoint, it speaks of deflation, and that tends to get some of the Western speculators short gold because they see gold and oil as being joined at the hip, as it were. However, if we have a monetary event, or really anything that gets gold on a sustained uptrend, what could happen is that the margins for the miners, if energy prices remain low, will expand much more rapidly than we saw during the last rise. The last time we had a big burst in the gold price, the miners actually saw their margins compress because oil and energy prices were rising for the very same reasons. And a typical mine, especially say an open pit mine, uses a lot of those big yellow trucks, and it's a very energy intensive process. Now, so we may see the reverse of that, in that we may see margins expand, and therefore the miners, their share prices may rise much more strongly and aggressively during the next gold price rally.
Back to the New Orleans Investment Conference, I like to use attendance of resource shows to get some type of a contrarian indicator on the sector. Sometimes when the shows have smaller attendance, it can indicate that there's not much interest in the sector and we're ready for a turn. How was the attendance at the show this year?
The attendance was actually pretty good. We just went over those numbers before I got onto this interview, and it really bottomed out. We were right about where we were last year. I thought that we were going to be a good bit below where we were last year, but toward the end we hit a bit of an uptick. So we were right about where we were last year, and a little bit lower than we were, say, 3 years ago. So it really matched the mood that I saw from the attendees, that people thought that the bottom was in to some degree. With that said, at the level of attendance that we had, which was around 550 investors, fully paid, in very highly qualified investors, we're actually outdrawing free shows at this point. So we don't, typically I have to make the argument that these are much more highly qualified, high-end investors, and that's why we don't get the kind of attendance that the free shows have. Well, these days we're actually outdrawing those shows. So it was very good for us. I think it was very good for our exhibitors, and our speakers were absolutely outstanding this year. I couldn't compliment them enough. Everybody seemed to bring their A game. They had great value, great content, and even the MCs of our panels had really done a lot of work in coming up with good questions for our panelists. So it was just a wonderful event from start to finish.
That's great to hear. And on our last interview, we talked about when these junior stocks do start to move, and a couple years down the line when they're moving in earnest every day. You made a comment about it's like owning your very own printing press, and I think people are losing sight of how amazing the returns will get one day in the future, but we're certainly a good ways away from that right now.
We are, and there's been a lot of damage done, and I know some of my more pessimistic brethren in the industry, and especially in the newsletter industry, think that it'll be a much longer, slower turnaround once the market does start to recover. But really, that hasn't been my experience. I've always been amazed at how quickly the market turns around when it does. One of the great motivators for people, I say there's three great motivators. There's fear, there's greed, and there's fear of being left behind. And that combines both fear and greed in one big motivation, that when people are making money, you don't want them to make money without you being involved. And the market, people tend to, for better or worse, and usually for worse, tend to jump into the market and just start buying willy-nilly, which is bad for them, but the market does tend to recover much more quickly than people expect in those kinds of situations.
I understand that you have a audio and or video recording of the show that's going to be available. Where can listeners go to get that?
They can go to our website, neworleansconference.com, and there'll be a button to click on to go to the order forms. We have all of the audio recordings of all of the general sessions and workshops, and we have the video DVD recordings of many of our most popular and compelling general sessions. And we also have this year an online streaming option where for a very affordable cost you can immediately stream a presentation. And that should be online within the next few days.
Fantastic. Brien, thanks so much. Always a pleasure having you on.
Great to be here, Colin. Really enjoyed it.